Well, welcome everybody, and thank you for attending today's. Welcome, welcome. Come on in. Get your pizza. Thank you all here in person and in the Zoom room for attending today's talk on strategies for financial success. My name is Eric Worley. I'm a professor of finance here at Western and the director of the Merriman Financial Literacy Program. And it's great to see some familiar faces in the room. I'm pleased to introduce our speaker, Paul Merriman. He graduated from Western in 1966 and is an award-winning financial educator, author, and nationally recognized expert on investing. He retired in 2012 from a wealth management company he founded in 1983, but since then has been busier than ever. His so-called retirement is he's driven by a passion for financial education, established a foundation, and has dedicated his retirement years to providing investors of all ages with free information and tools. These tools can help you make informed decisions in your own best interest and successfully implement your own retirement savings programs. Paul and his small home-based team have produced hundreds of weekly podcasts, market watch articles, and videos, along with books. Some here are available free, and they're also available online for free, and articles by experts and unique research to help you make wise financial and investment decisions. After this talk, I encourage you to check out some of the resources and free books on his website, paulmerriman.com. It's just his name run together.com. If you're interested in diving deeper into what we learned tonight, and as a fellow Viking, Paul cares deeply about your future, and we are grateful to have him here to share his insights and advice on creating a successful financial future.
That's great.
Some of you submitted questions with
your
registration, some housekeeping, and we appreciate those. I'd like to point out to those of you online that there is a Q&A feature you can use to submit questions. And when the time comes, we will be monitoring questions from both our in-person and online audiences. We'll do our best to answer as many as we can during our time today. And with that, I will hand it over. Please welcome Paul Merriman.
Thank you. Thank you, Eric. Thanks. Well, it's a thrill to be here. This is for me, having a chance to, at least most of you, I think, are seniors about to graduate. And the fact that you're going to take one of our books with you gives me hope that something I might say here today will stick, because you might go back and read the book and maybe share it with a sibling or people that would also benefit from it. I'm going to be fairly quick. I've got an hour and a half, and I made this presentation to a class in about an hour and 50. I will make it. And so let's get going. And by the way, I haven't had a nap in days. You cannot believe how tired I am right now, and I feel so energized. All right, let's get to work. Mission statement: to help you people do the right things. How to know the difference between what's in your best interest and what is in the best interest of Wall Street and others who may not be, in fact, working for you, but working for themselves. I have to say this: I am not an investment advisor. I am an entertainer. So this is all to be considered entertainment. If you want to get serious personal advice, either do some more study or meet with an advisor. I want to just briefly say that I love teaching here, but I want, for full disclosure, I am more preacher than I am teacher. And the reason that I say that is because a teacher really has to kind of give you both sides of every fork in the road that you might come to, probably might not try to influence you to take one fork or the other. I come to the fork in the road and I do everything I know to influence you to take one fork over the other, because from everything I've learned since 1963 about investing, I think I know the right things to do. And what is in my best interest is to simply tell you what the academic community has decided is the right path. I am sharing information that really comes from on high, from academics who have been, in one case, rewarded with a Nobel Prize. So I'm here to not only show you the math, but make sure that you don't ignore the history. One of the greatest teachers and preachers about investing is Warren Buffett. The thing about Warren Buffett is he has done what, before you leave here, that I'm hoping you will consider to do yourself. He doesn't look at investing something speculative, something that you worry about every day, something that you You're studying all the time to figure out how you just get a little small advantage. He is an investor for the long term, and I'm here to share some of that information. He does say something I think is important. To be a success, you only have to do a few things right, as long as you don't do too many things wrong. And I think it's important not only that you know the right things, that would be one fork, but I want you to know the wrong thing, because a lot of people want you to do the wrong thing. And that costs you money. I'll show you how much in just a few minutes. I want to just briefly say, probabilities are really important to me. I'm 81, my wife is 77. There are chances, probabilities, that, for example, one of us will be alive at 100. One of us will be alive there's a 35% chance that one of us will be alive at 95, etc. Most people underestimate how long they're going to live. What's interesting is, when you're your age, there's about a 2-3% chance that a 21-year-old is going to live to 100. They got a lot of possible, particularly the men have a small chance compared to women to get to 100. And really, it turns out, if you eat right and exercise, the chances are that the male will go up to an 8% chance and the female a 12% chance. And if you have the right genetics, you even go a lot further. And my question is, is it worth doing the right things to control and to give you the opportunity to do better with your health and with your life and with your money? It's the same thing. But you always remember, when it comes to eating, the tobacco companies want you to smoke, the liquor companies want you to drink, and the food industries seem to want you to pick where the Coke and the potato chips and things that aren't so good to you. So there's a big industry out there of offering you things that is good for them, but maybe not necessarily good for you. If you're going to have more financial success, I think it's the same thing. I think that there are things to do that are in your best interest, and that if you do the right things, not the Wall Street calling or the insurance or the banks, if you do the right thing, the outcome is, it's not about having piles and piles of cash. It's about probably retiring earlier. It's about retiring with more to spend if you keep on working. It means leaving more to others. That's why my wife and I are able to help Western with our program here, is because we did the right steps earlier. Corporations, of course, they want you to buy lottery tickets, speculate, do day trading, buy cryptocurrency, bet on sports. If you don't know it, one of the most profitable businesses in the world is sports betting. Unfortunately, it's not for you profitable, it's for the people who offer the service. And you know that when you got a few bucks in your pocket, there are people who want you to buy new cars, take on debt, keep up with the Joneses. Not necessarily in your best interest. And there is a step that you can take, and I'll show you in a second. But right now, I want to talk about the math, the guaranteed part about investing, because I'm only talking about numbers and multiplying one number times another and adding one number with another, and the outcome is guaranteed because it's simply the math. It's theoretical, but I think it's important to know. Here we have a person at age, let's say 25, going to invest for 40 years, going to retire at 65, going to retire and die in 30 years, ending at 95, and when in retirement will take out 4% a year to live on. Now, here's what we know about that. If you make an 8% compound rate of return, and I'll show you exactly where I think you could with relatively low risk, and then when you got into retirement, you reduced your risk and you took out 4%. Here's what we know about the math. You will have contributed $240,000. You will have about $1.7 million left in your portfolio to support you in retirement starting at age 65. You will end at 95 with $2.8 million, and you will have taken out $2.6 million. If anybody wants to know how I did personally on this. I haven't died yet, so we don't know. But what I do know is when I have died and we know how much is left and we know how much was taken out, that will, $5.5 million will be the return on the $240,000 investment spread out over 40 years. Here's what's encouraging. That is that if you could just add 0.5% to the 8 and 0.5% to the 6, you would pick up another $1.5 million just because of 0.5%. That book that you got a copy of, that has 12 ways. Most of those 12 ways are about how to make an extra 0.5% or more. And so it's not like it's impossible. There are ways you can almost just bend over and pick up the money off the ground, and I'll show you what those are as far as I'm concerned. Now, I just quickly want to show you that if instead of 0.5% additional something here, you go to 9 and you go to 7, so you've added 1%. Now, before, that difference gave you an extra 1.5 million. Now it's 3.5 million. So by finding in another 0.5%, it does more. I mean, you got money growing on money. That's the way that investing works. And so you end up with 3.5. Now, let me just tell you something, how easy this is. I was an investment advisor. I charged my clients, let's say I charged them 1%. A lot of people do. And that would mean that difference between the 8 and the 9, the 8 is what you'd be left with if we made 9 and I got to keep 1. You with me? Which says, if you learn how to do this without me or an advisor, you have literally over a lifetime, you have just picked up an extra 3.5 million. And that's investing $240,000 over a 40-year period. Now, let's just do one more thing here. Let's add 3% each year as we put money in. Let's go with the 7 and the 9 and the distributions. That means instead of putting away $240,000, you put away $452,000. Now here we have, remember, the return was about $9 million for the 9 and 7 before. Now it is 12.4 million. I mean, those are big changes because you controlled your spending and it left you more money to put in. And the increase was about 3% a year. You could say, well, that's from inflation. You could do that because you're making more money for what you're doing. However you get there, putting away more money obviously has an impact on you. And then, this is big, one person starts at 25, the other one waits 5 years at age 30 and starts putting the money away. I just want you to see that the difference at the end of this lifetime, waiting just 5 years, that difference is $4.7 million because you waited 5 years. And I even think that for some, in fact, I know a lot of people who in those early years find a second job to make the money so they make sure they put away some money those first few years because they are golden years in terms of future growth. Now today we're going to have a drawing. How many came just for the drawing? Oh, just a couple. Nice. I mean, the odds are pretty good actually. And Eric has, I have no idea who it is. Eric doesn't know this person personally. And we're going to tell you who that is in a while. I don't want you all to leave. But here's what I'm hoping you're going to do with that $1,000. I hope you're going to put it into a Roth IRA. I know that if you could get an 8% compound rate of return, that between what you make, leaving it in a Roth IRA over the 45 years that you let it grow, and then you took distributions for 30 years, about $71,000. And at the balance, at the end of your 97th birthday, you still had $65,000 left. And then you left the money to your kids, and they got 10 years they could take money out, and you take the money, all of this is tax-free, all of it's tax-free. The kids take out $89,000, and then when the thing is finally excuse me, the kids took out 38,000 and there was still 89,000 left in the account after the 10 years for that lousy $1,000. And so the total benefit was 199,000. Now I'm looking for you to do better. I really am, particularly with this $1,000 and something I'll show you in just a minute. But what I want you to do is to invest so that I have an honest shot at 10%. 10% return that's been experienced for almost 100 years in a relatively conservative investment that you all can participate in if you wish. You can't participate in the past, you can only participate in the future, but we can hope for the best for you, obviously. But instead of 8%, if you made 10, it would be an $814,000 payoff over your lifetime for that $1,000. And again, all tax-free. Then at 12%, and I'm going to show you how you can make 12, at least I can show you how you would make even more than 12 over the last almost 100 years. So it's not impossible. It's not impossible. That would take a total outcome of about 3.3 million that you would in some fashion receive tax-free from, and you don't have to report this $1,000. The only thing you have to, well, it's up to you if you want to report the gift, but there's no tax on the gift. This is a gift from me. Oh, by the way, I've got some bad news. I am at 81 forgetful. I brought my checkbook, but it's for the foundation and not for me personally. So when I go home, the first thing I'm going to do, whoever this person is, I'm going to send them the $1,000. I want it to be in a check so it's less likely for you to spend it between the time you get it in, okay? Now, here's something I want to recommend to all of you. I don't know if you can do it right now, but I want you to start putting away $100 a month. That's what I want you to do. I want you to do it for your financial future and your family. And what I want to do with that $100 is put it into 3 different investments. What I mean is you're going to choose the investment. But if you put it into an 8% rate of return investment, and again, I'll show you what I think that is, then the total benefit to you and your family for that $100 a month, and by the way, that's $54,000. I want to change your thinking for just 1 second. Don't think about investing in the stock market. Think that what you're actually going to do with this money is buy a business. Warren Buffett doesn't invest in stocks to speculate and to buy them with the possibility of selling them at a profit. That's not what he does. He invests in business intending to hold them forever because they are good businesses to be in. And I want you to do the same thing, but I want you to do it with $100, almost like paying a mortgage on a house. And what happens when you put that first $100 in, it immediately starts earning something, dividends maybe. Maybe it'll go up in value immediately, maybe it won't, maybe it'll go down. But eventually, these mutual funds I'm going to recommend, and in that mutual fund, you'll have 500 legitimate companies that you are an owner of. And the fact that you don't have to do anything but just sit on your hindsight and let that money grow and let other people go to work, millions of people working for you. And you literally get a piece of the action. You will own a part of Microsoft and NVIDIA and all of those companies. You'll own Exxon. There are 500 big companies that are legitimate. This is not like it's a speculation. You are buying a business. And in essence, it's like a mortgage, and you're going to pay for that business at $100 a month, no interest. But the first year, you might have $1,200 invested. It might be worth $1,300. It might be worth $1,100, but you're in it for the long term. If every business owner sold the firm the first year we had a tough time, you wouldn't have most of the businesses that are around. It takes time, and those people are working for you. And they're not all honest. I mean, it's just real life, except you don't have to face it because you're a passive investor. You're not there in the office. But if you look at the long-term impact of that $54,000 at 8%, the total benefit is $3.1 million. If you made 10%, that would be like the S&P 500. That would have grown to about $10.6 million. If you had been at got a 12% return, it would be $37 million will have been paid out from that $54,000. And let me just tell you, that is better than real estate. Really. Real estate grows at about 5%. I don't mean there aren't developers who make more money than 5% on building homes, but this is where I think you can make a lot of money. And I think you have to break it down into small steps. That's what Mark Twain says. The secret to getting ahead is breaking the task, small steps. Those steps are so easy. I mean, literally, high school kids do this. By the way, I asked this young man, oh, he's gone. I asked if he knew about investing, and he said, no, but I know about erosion, which I thought was pretty good. The book, I mentioned the book here, and you'll notice this guy, Richard Buck. Richard and I have been working together for, I don't know, 30 years. I actually outline, he actually writes. I am not a writer, and I'm not a teacher, but I get help, and so I think it's a pretty good book, and you'll learn 12 simple ways to supercharge your retirement. I'm not talking about buying the next car here. I'm talking about putting money away for the rest of your life until you retire. So you come to these very simple major decisions, the save versus spend. That is a $1 million decision. It's a multi-million-dollar decision. We saw even with $100 a month. By the way, you could divide all those things by 2 and do $50 a month. That wouldn't be too bad either from what I just saw. So the questions are pretty easy, and that is, where do you need to save? And to remember, the fellow that wrote one of these 2 books up here, another one of our directors, reminds us that saving is actually putting money away to save is spending later. You're going to spend it, or somebody's going to spend it. It's always for spending in the end, or giving to Western, if you will. Do not save what is left over after spending, but spend what is left over after saving. That means pay yourself first. And the problem is, if you wait until the end of the month to see what you have to save, the reality is somebody's going to find a way, a good thing to spend that money on. And it's a tremendous defensive step. And what we find out is, and there are lots of studies, if people put this money away, then they live without it and they let it go. And in fact, they even do this in very poor countries. People in some cases are able to save just because they make that discipline part of their life. I want to show you one more, because this is the decision to start now or wait till later. I just want you, your seniors, when I was 19 years old and going to school here at Western, when I was married, I had my first child when I was 21 here at Western. I was going to school. In fact, I stayed up most of the night with my wife, going through the labor and all. I had two finals the next day, and neither one of those professors would let me off. I had to take the test, and they were an accounting course and an economics course, and I did okay. But here's what you do. You put $1 a day away for a kid. We do something for every one of our grandchildren. When they're born, they get a little money put aside for the future. $1 a day from birth to age 65 at 10% grows to almost $2 million. That's a pretty big deal that's a gift, a big gift. Now, if you just waited for 10 years to start, wait till they're 10, it's $755,000. That is the cost of waiting 10 years. that difference between almost 2 million and 750, that is the cost of 3,650 contributions into that investment. So time is such a powerful, and if you waited until they were 21, and that's a very common thing to do, is to wait until people are older to start saving, but it goes down to 262,000. Stocks versus bonds. Stocks are about owning those 500 companies. Bonds are about loaning money to the government, loaning money to corporations. There are bonds that are speculative or risky and bonds that are not risky at all. But at the end of the day, the high versus low short-term risk, low risk with loaning, almost always get your money back, but the return is very low. And the risk is very low. Stocks, the risk short-term is very high. One day, October 19th, 1987, the stock market went down 22% in one day. And that was really jarring. People thought it was the start of a depression. As so often happens, the reactions that people have emotionally have very little to do with what the market actually does in the long term. It came right back, and the next year it was fine. Now, on the long term, the risk of stocks are very low. I'll show you the numbers in a minute. And bonds are very high risk because of inflation. They don't make enough to really give you real meaningful growth. And that's what you're looking for, long-term money for retirement. You're looking for growth. So then we want to follow the history. Here's what we know about what did actually happen or close to it. And let's see what lessons we learned there. First of all, let's look at the returns of bonds. The returns of bonds, if you put $100 into bonds back here 97 years ago, there are three kinds of bonds here. You don't have to know much about them, except the one on the left is less risky. Okay, I know it is because it didn't give you much, but you made $2,300 on $100. You made $9,700 on one that's a little more risky, and on the one that is the most risky of the three, you would have made almost $12,000. Now keep those nothing over 12,000. Let's just remember that. If you looked at the stock market over that same period of time, you would see that there are companies that are big companies like the S&P 500, names that you would mostly know in that group of stocks. In that group of stock, $100 grew to over 1.1 million. Now think of that, making a decision, a fork in the road, where historically the return for $100 was either $12,000 or $1 million. And yes, one is very, very high risk short term, but there's nobody, particularly this $1,000, whoever won, you're talking about a 50 or 45 year, your first bite at the apple is supposed to be in 45 years. So you want to be in equities for the long term. Now there's four different kinds of equities here. Large companies that are out of favor, these companies, these S&P 500, their average size company, $300 billion, let's say. Over here in another category, small cap blend and small cap value. I'll talk a little bit more about them later, but they are about $3 billion in size. They're small compared to the big companies. And the returns for the small ones are higher than the returns for the bigger ones, for the ones that are less risky. That's the way this whole process works. You get paid a premium for taking risk. Now there's smart risk and there's dumb risk. There are people who will take very high risk, buy penny stocks because they think they're going to get rich on a penny stock. They take high risk and the returns are traditionally very low. So there are some places where you do not get that premium. In fact, the premium goes to the promoters. Okay, so we have different compound rates of return, 10, 11, 12, and 13. And you can also put these together too. let's just look at this one right here. This 4-fund strategy, put the 4 of them together, and you had almost a 12% compound rate of return. And it is legitimately lower risk than the S&P 500. That's the magic of diversification. These are the average 40-year periods for these different kinds of stocks. Here is the S&P 500. The average 40-year return is 11. For large cap value, 12, 13. For small cap blend, 13.6. And for small cap value, 16. By the way, I don't expect small cap value to get 16% in the future. It's been getting over the last 55 years about 13%. So it has made less because nobody even knew about it 97 years ago. And so as people understand these things, that premium tends to shrink over time. So decision, one stock versus all. Well, let me make this quick. With one stock, you could lose everything. It could go bankrupt. Lots of companies go bankrupt. As a matter of fact, since 1928, half of the companies either made no money or went out of business. Half. So not every public company makes it. That's why you want to own a whole bunch of them. It is interesting to note that even though if you owned all the companies, you made a 10% return, it was 1 out of 25 that caused the compound rate of return to go from 3% on 96% of the companies to with a 13.7% compound rate of return from 4% of the companies. A very few companies made you that 10% company return. The rest of them just didn't do much. They did something for a while in many cases. I already talked about thinking and acting like Warren Buffett, owning a bunch of individual companies in one mutual fund. Now, mutual funds, I suspect you all know what a mutual fund is. Very briefly, started in the mid-20s, and I'm sorry, that 1920, and it allowed companies to accumulate, get money from a whole bunch of investors, and manage it all at one time. So that $100 that you put in on each month, it is being managed exactly the same as somebody who owns $1 million. You are treated with more respect. Come on in. Take one of these and take a book too. Get it while it's hot.
Thank you.
I do not know any kind of a product as efficient, and they're way more efficient for today than when I came into the business a lot of years ago. But here's what I know. You can buy them without any cost, no commission. You have 1-day liquidity. You can get out immediately if you want. You can sell small amounts. You can sell the whole thing. And when I said before, every investor is treated equally so that you get the advantage of not only professional management, but broad diversification. That broad diversification, the studies show, the broader your diversification, the higher the expected return. Some people think, well, if you own 500 companies, you'd be better off owning one really good one. The problem is, yes, one really good one would be a great idea if you knew what it was going to be. Unfortunately, so many times, anybody know what happened in the late 90s in the stock market, 95 to 99? The stock market, at least part of it, most of it went up over 28% a year for 5 years. Think of that. 5 years, 28% a year on compounded. Many of those companies then, from 2000 to 2003, lost 80% or all of their value. And so there seems to be somewhat of a reversion to the mean. When something gets too hot, it normally gets in trouble. Here is the easiest way to make more money, because mutual funds do charge a fee. Some of them charge 1%. Some of them even charge 2% to manage the money. Some charge 0.03%. If you could buy the same kind of a fund, and one of them charged you, in fact, Fidelity has one, they don't charge you anything. And if you could get it free versus somebody charging you 1%, remember we were looking for a 0.5% somewhere? Well, there's a 0.5% right there. Get it in getting lower expenses. And those expenses, they go on forever. As John Bogle says, returns come and go, but the expenses go on forever. You want low expenses, it'll help you get the kind of return that you're looking for. I mean better. That's what I'm looking for. And then there are mutual funds that the fund people who manage them are called actively managed mutual funds. The people who manage them are looking for the best companies. They're looking when is the time to buy, when is the time to sell. They're looking for being better than the market. They all want to beat the market. I've talked to many managers of mutual funds that actively manage. They all believe they can beat the market. But the reality is the market itself, what they call an index of those 500 companies I've been talking about, that's called the S&P 500 index. At the end of 20 years, and that's relatively long period of time, at the end of that 20-year period, only about 1 in 10 of those actively managed mutual funds are able to beat the S&P 500. Well, if I knew I could be in the top 10%, virtually guaranteed, versus maybe being in the bottom 10% or the bottom 25 or the bottom half, whatever, I want to be in that top 10%. And the thing that's so cool is that these index funds, that's the funds that are passively managed, that they're not trying to beat the market. They're trying to be the market. They're trying to replicate the market, which sounds like they're lazy. But in fact, they end up with better returns. And they have lower expenses. They are more tax efficient. And they have more diversification. So these are all available. The large cap blend, the S&P as an index, large cap value as an index, small cap blend as an index, small cap value. Those what we call asset classes. Equities and stocks are the same thing. So these are equity asset classes. You can invest in those classes as a standalone investment in a mutual fund. Now you can see the pain can be big on the downside. The worst year for the S&P 500 was a loss of 43. That's a calendar year. The best was a gain of 54. Over here was small cap value, the gold ring of asset classes. The best was 124, the worst was 55.4% loss. Yes?
Blended value.
Blended value. Blend is a combination of growth and value. Growth of the hot companies, they typically have a PE ratio, price to earnings, of about twice that of the value companies that are out of favor. People aren't willing to pay very much for the earnings, like they might make $1 and they'll sell for $10 in the market, whereas a growth company will make $1 and will sell for $20. And the reason they sell for 20 is because they're a company people think has a lot of future, a great future. So a NVIDIA, a Microsoft, those kinds of companies would have higher PE ratios. Exxon would not. It would be less glamorous, less growth oriented, more kind of traditional. Thank you. So I want you to add some small cap to your portfolio. I would, because if it compounds at 9 or 12 and the market at 10 and small cap value at 13 and the big market, the less risky, then that would help my return. And the same thing with value. I want value. I want large value, small value. Again, these are all ways to expand your diversification and give you the opportunity for a higher rate of return. People, particularly inexperienced investors, have a tendency to make a mistake that can cost them half of their life savings easily. Just like a divorce can cost you half of your life savings, okay? Except what they've done is they got scared. They got scared, and so they jumped out of the market. It's not unusual when we have an election and the person who is elected is not viewed nicely by the opposition. And so the people who didn't win the election, in many cases, they'll say, I'm getting out of the market. I've had people want to get out of the market when Democrats got elected, and I've had people want to get out of the market when Republicans got elected, because all they could see was loss. Stupid people running our country. And the interesting thing is, if you look at the history of the returns with presidents, it doesn't matter. They have virtually the same compound rate of return after inflation. After inflation. Because well, it doesn't matter. Don't have time for that. But what does matter, I want you to stay the course. I know, if I told you how to market time, I know how to market time. I can't tell you how to work, how well it will work for you, but I know a lot about market time, and I studied it in the 1960s and continue to study it most of my adult life because I find it a fascinating way that people react to the market. And what we know is if we tell 100 people exactly how to know when to get in and out of the market, and by the way, nobody knows when to get in and out of the market, but if I told 100 of you, the odds are your returns would mostly not be good. That's one. The second thing is they'd be all over the place because you'd be overriding the system that you might supposed to be using and second guessing what to do next. On the other hand, if another 100 people were told to put their money in the S&P 500 and leave it there, all 100 of them would have exactly the same return, except maybe for expenses in one versus another. But they'd have the same rate of return for 100 years. The highest probability of success for the long term, if you want to base it on probabilities, is to buy and hold. Stay the course. Dollar cost averaging. When you start doing a 401k, maybe you already are, you're going to be putting money in every month, and every time you put it in, it buys shares, the number of shares based on the price. If the price of the mutual fund that you're investing in is going down, it means your money buys more shares. If the value of that fund is going up, it means you're going to buy fewer shares. What it does, it guarantees you buy more shares when the market is down, which over the long run improves your return. Many people want to market time and not invest when the market's down. They're afraid they're going to lose money. One of the most costly state of mind is the fear of losing money. That keeps you from making money, actually, unfortunately. This is easy. We all know that if you pay more in taxes, you take home less money. I mean, that's pretty simple. The wonderful thing is you have this choice. You can be in a Roth IRA. First of all, you can be in a regular IRA, regular 401k, and get some tax deductible events. But on the other hand, when you cash out, they're going to charge you a tax on what you take out. But you do get a deduction for that money when you put it in. On the other hand, if you use a Roth IRA or a Roth 401k, and the reason I want that $1,000, whoever gets it, to go into a Roth is because they never pay any tax. They don't get a deduction, but they never have to pay tax on all the profits. So if you look at, what would the tax deduction be on a contribution for $1,000 if you're not making a lot of money? Almost nothing. And so you have everything to gain by putting it into a Roth. I mean, literally 100 to 1 or better. Target date fund. That is probably the investment that most of you should be in for the long term. It's not exactly where I want you to be, And I'll show you what I want you to be if you're going to use target date funds. We didn't have these when I was your age. We didn't have index funds when I was your age. We didn't have many no-load mutual funds that you could buy without a commission. We didn't have a 401k. We didn't have an IRA. We didn't have ETFs. And there's so much we didn't have, which means that you, as investors, should do much better than I did. Literally. The industry is now for you. It's built for you because you can cut Wall Street totally out. Almost totally cut out Wall Street. And when you cut out, has Wall Street had a long run of profitability? Have they made a fair share of money? Do they buy better cars? You want to keep it in your pocket. And the thing about a target date fund that's so cool is that you have to make one decision. Anybody know what year they expect to retire? Or make up it. Anybody want to shout out a year that you think you're going to retire?
65.
What was that?
65.
2065. Okay, 2065 means that you're going to stop working. You're going to have invested for the time between now and 2065.
Age 65, I meant.
Oh, age 65. That's fine too, if you want to look at it that way. But they have every 5 years, these target date funds are set up so that if you figure out that when you're going to retire is 2065, which would not be an illogical number for a lot of people, that means that you put that money in and the professional people who are managing that account know you are going to retire in 2065. Now, you may fool them and retire in 2050, but at least the intention was that you're of a certain age, and because you're young, they'll have you either all in stocks or mostly in stocks. And so that's the way it should be. And then when you get closer to retirement, what they do is they start adding bonds to the portfolio because I got 50-50 stocks and bonds. The stocks are for growth. The stocks are for growth for Western. The bonds are to make sure I have enough money to pay what we need for our cost of living. And so you do change over a lifetime, or you should. A lot of people don't have a clue when to do it. So the fund does it for you. And it is broadly diversified. So they're made up of a mutual fund, started in the 20s, made up of index funds. Not all of them are index funds, but the only ones I want you to be in are index funds underneath the umbrella of the target date fund. So you have low expenses, you have broad diversification, and then in, I think, 1993, the target date funds. Index funds were 1976, target date funds in 1993. So you get all the diversification with the mutual funds, the low cost, all those things that we love about mutual funds. You get all the low cost and broad diversification of the index funds, more diversification, higher expected returns, and the target date fund then means you don't have to do anything except the saving it. And then all those people run out and go to work for you. I mean, that's the whole idea. And it's so simple. And for most people, this is the go-to investment in 401ks. Most money, over 50% of money being invested today in 401ks is going right into target date funds. Out of curiosity, how many people think, when you think about manipulating your investments and making all those decisions, how many people want to actually take care of it and make the decisions and know when to add the bonds and all of that? How many want to do it all? Okay, there's only a couple of hands. Those hands would be fine to be in irregular funds, and you do your own glide path. You decide to go into bonds. You decide how much in large companies. You decide how much in small companies, how much in international. But the rest of you should have target date funds, probably, theoretically. Now, I will tell you there are things that I don't necessarily Oh, by the way, yeah, here is how a target date fund. Here's two different target date funds. One at Vanguard, and I believe this one is at BlackRock. This orange color, that's the bonds. You notice Vanguard's had bonds here in the early years as part of the portfolio. I hate that. I really dislike that. And they've got a reason why they do it, but I don't even like the reason they give that they do it. And the reason I don't like that in your portfolio at age 20, in the 20s, is because every 10% you have in bonds is going to reduce your annual return by about 0.5%. Okay? And anything that reduces your return by 0.5%, I don't like it, unless it's doing something for you. But if it's actually doing something bad, and the thing that it's doing that's bad is that when you're investing that bond part of your portfolio into the market, I mean, into your retirement account, and the market is down, you don't want to protect yourself from loss. You want to have all of your money going into those lower price securities. You want to take that risk. And then when it recovers, you have more money. And that 10%, what does it change? I mean, the loss, the minimizes the loss a little tiny bit. You're still going to have a big loss, theoretically. But the people at BlackRock, they wait until you're older. So not every target date fund is built the same. I just love this study. Wharton did a study of 1.2 million target date funds. And that's people who don't want to do it. And there were just a few people who wanted to make those decisions themselves. And the interesting thing is, in the study, they found that those people who did it themselves, the people who did it themselves had an expected return that was 2.3% more per year than the people who were trying to be smart and outdo the market. Which means those of you who may feel like, oh, if I just turn it over to those people, I'm not likely to do as well. It's just the opposite. You are likely to do better than most people who do it on their own. A lot of people, when they do it on their own, they sit in a lot of cash because they're afraid of the market. They're making that market timing decision, and they sit in cash when markets are going up like mad and losing out on some great opportunities. Anyway, I think target date funds are great. The problems with target date funds are pretty simple, and I think they will cost most of you who use them, they'll be fine. But I think it'll cost you $2 million. All right? And the reason it will cost you $2 million is, one, because many of the target date funds that you'll end up in, because you're going to be at the mercy of the company you work for, whatever what their choice is, and they may have picked a choice of a target date fund that has bonds early on. And the other thing is that they have very little value or small cap. And the big returns were taking the risk of adding value or small cap. There's another book. By the way, if somebody sees that you have a copy of this book and they want a copy, and you say, I'm sorry, but you can get it free as a download at paulmerriman.com. Will you do that for me? Then, if they say, I really want to learn more about target date funds, Chris Pedersen, our director of research, and one of the nicest people I've ever met, who volunteers over 200 hours a year to work for our foundation, he wrote a book called Two Funds for Life. And it's it's written by an engineer, okay? So it's got a lot of numbers. But I will tell you, it's a really good book, and what he is basically recommending is you put most of your money in a target date fund, and you take 10 or 20% and put it in small cap value. You will likely be able to do that. Not all of you will, because it may be your 401k does not have small cap value. I spoke to a bunch of the folks here on campus yesterday, and Western in their 401k plan has one of the premier small cap value funds in the country. That is so fortunate. The problem is not many people use it because they think it's too risky. But if you put money into with 20%, it barely changes the risk. And look at here, the return for investments of $10,000 a year plus inflation over 40 years in a regular old target date fund would grow to amount about $8 million. If you simply added, you put 90% into the target date fund and added 10% in small cap value, it drives it up to over 10. If you do 20%, it drives it up to over 12. Now, it sounds like I'm saying it will go up that much. I have no friggin' way to know what it's going to do. Nobody knows the future. And anybody you ever talk with who is trying to tell you what the stock market is going to do, they cannot know. Because for 25 years, from 75 to 99, it went up 17.2% for the S&P 500. You know what people believed who were surveyed in 1999? They believed that for the next decade, the S&P 500 was going to compound at over between 20 and 30% a year. Part of the reason they believed that is because 95 to 99, it did compound at 28% a year for 5 years. What actually happened in that 10-year period from 2000 to 2009 was it lost 1% a year. So people, there's another book I want you to read, and it's available free at our website. It's called Spending Your Way to Wealth. And I only want you to read the last 16 pages because there's a very famous book written by Professor Daniel Kahneman. He got a Nobel Prize. The book is called Thinking Fast and Slow. It's 500 pages long. I don't think anybody will ever finish it. But I do know that what was done in that last 16 pages in Paul's book was to condense the, I think, 48 human biases that we have. We have biases. We believe that what's been going on lately is going to continue. And that's just human nature. We believe that what more recently happened is more important than what happened 50 years ago. When it comes to investing, that's not true. All of the past has been unpredictable before, and we will never, ever see the same sequence of events of earnings. It's just not going to happen. So,
that book is on the second to last slide of your handout, and we'll make the slide.
oh, it's on the second to last line of the handout for people who want to get a copy of it.
Here for free.
Now, if you like the book, the 16 pages, the rest of the book is about how to deal with those emotions. Fear of loss is huge. Fear of loss keeps people from doing in fact, that's one of the biggest. So what should you be doing? Well, I want you to start saving, obviously. Even if it's $5 a month, I want you to get some skin in the game and just feel how it works. It's very simple. And if you go to paulmerriman.com and you go to boot camp and you go to a topic, fixed contributions, because it's a picture of what your life is going to look like as you put money in very small amounts into the market. And we will have there links that take you through to different levels of risk. So you could see what happens if I want to be conservative, because you can be conservative. You don't have to be all aggressive if you don't want to be. It's your call. And you can see year by year what's happening to the difference of putting, we start that table with $1,000, $83.33 a month. And then we up it by 3% every year. So if you're going to do $2,000, just double all the numbers. I mean, it's an easy number to work from. But I think you should try to get yourself up to 10% now, savings rate as fast as you can. A lot of people, and by the way, if you got a company match, you got to find that money some way. Take a second job because it is free money. The company is going to match. People who work here, they get to, I think they match the first 5%. So if somebody if they're making $60,000 and they're putting away $3,000, then they're being given $3,000 and it's put into that tax deferred account, compound tax deferred. Of course, I want you to pay off your student debt. But I will tell you this. If I had student debt at a low level, and I would like one of the retirementers who might be willing to take a stand on this, is there a retirementer who has a desire to tell us how much debt, how much interest would you pay the thing off as slowly as you can, or how much interest would be costly and you'd want to get it paid off as soon as possible? Anybody got that number? Nobody's got that number? Really? Project number 1 for tomorrow. If you are being charged let's say 6% or below, some say 7%, you may not want to rush. You may want to take part of the money, and you got to meet whatever your required payment is. But if you don't, if you have a range of how much you can pay, if you're able to put money certainly and get a match, we would want you to reduce the payment on the debt if the interest rate is low, and get that match. I would even take the risk, even if I didn't get a match, to get that money set aside early. It's such a big deal later on. By the way, before I forget, how many of you know that you all have iGrad available to you for the rest of your life? Anybody? Okay, it looks like maybe a third. One of the things with the program, the financial literacy program that we've established, my wife and I have established with Western, part of what we're paying for is for you to have access to a very fine online course material to help you understand many of the not just investing. We're talking about things like when you're going to get a mortgage someday, or insurance questions. It will give you the training that you may not have gotten here because for most people haven't taken a personal finance course here. But that is there. And by the way, if it knows you don't know anything, it treats you like it. If it knows you got to have had experience, it treats you in a different way. It can tell you about things that are a little different than if you don't know. And it is something you could use for a lifetime. And people who are alums and students have right to access to this. And if you went to buy it for a lifetime, it costs you a lot of money. So it's one of the best gifts that we think we could give to you for your future. Anyway, build a budget. I think a budget's a really big deal. These are free budgets you can do online, but you can jump in to your iGrad and get it right there too. Oh, there is iGrad right there. I wouldn't have forgotten. Okay. Mini courses, daily updates, articles. I mean, they're trying to keep you up to date with what's going on in the world of money. And let me just tell you, sadly, almost Every part of your life has to do with money in some fashion. It is the reason, money issues are the reason for most failed marriages, they tell us. And we were just talking today about how when you start in your relationship with iGrad, they get to know you. So they're not working blind. And you're not getting to know by a person. It's all just online. And maybe you will need a side hustle to make the money to make that first 5 years and give you a chance to retire earlier, to have more income in retirement, to leave more to others. It's a sacrifice, I understand. When you get started, if you don't know how to get invested, I like Fidelity. The reason I like it, there's no minimum. You want to open up a $100 account and put $25 each in a S&P 500 ETF, in a large cap value ETF, in a small cap blend ETF, in a small cap value ETF. And because you don't know which one to buy, you can go to paulmerriman.com and we have recommendations of what ETF that you should consider. We don't know anything about you, but they're the ones that we like for our money. But it's very easy at Fidelity to get signed up. You just go to fidelity.com. They tell you, click open an account. I mean, you know how to follow that. You will need to get money into the account. You can send a check in, or you can wire it in. And here are some funds you could, now I'm not recommending all of these, but the reason I mentioned this one right here at Fidelity, it's a total market index. It's got more stocks in it than the S&P 500. And it's one of these funds that have no expenses. This is my favorite small cap value. Here's, if you're at Fidelity, a Freedom Index. Not just the regular Freedom, the Freedom Index, because it is made up of index funds. The regular Freedom account uses active management. Anyway, there are some things you could start with. And I hope someday you go to my boot camp. Because these are the big decisions you'll make: stocks, bonds, how to take money out. Here's the fixed contributions area, but you can go to a boot camp link at the top of my home page. So there's that book. There's the other second, Two Funds for Life. There's your Spending Your Way to Wealth. Here I am. I take emails. I take questions. I do a weekly podcast. I do a lot of videos. I do an article every couple of weeks at a site called Market Watch. But we run those articles on our website because Market Watch charges for. And by the way, all this stuff I think there is in the right here on the back page. Now I've got a few minutes. Oh, the winner of the drawing. Are you feeling lucky? Come on, are you? Now it's possible the person won't be here because people who attended some other classes qualify as well, because I taught, and I just felt unfair because they had to sit through me for even a longer period of time. And
yeah, that's fine. And so if you're present, you win. So let's get a drum roll.
okay, oh, the drum.
Drawing with row 48, the random number, Kyle Hansen. Are you here?
All right. Congratulations, Kyle. So, right, and do me a favor on a piece of paper, or you can email me, paul@paulmerriman.com. I need your phone number, I need your address, I'll mail the check to you. No salesman will call, okay? but I will want to talk to you and see what feels right, and that's great. Congratulations, thanks, that's great. Okay, do you have some questions? Typically, those target date funds start at about age 40. I actually think waiting to 45, depends on when you're going to retire. In a sense, the bonds are there to stabilize your portfolio, that if the market goes south, that you're not having to take money out of your stocks rather than taking money out of your bonds. By the way, I would love to hear literally from all of you about if you do use iGrad, how it worked for you. I want to, because my wife and I are paying for this. I would really like to know if it's doing what we're hoping it is doing. And any comments you have about tonight, you can add them in the email to me. And also if there's anything else I can do, I have a real affection for this campus and the people who go to school here, even though I don't know very many personally, but there are lots of people who need help that I could choose, but I just felt like doing it for the place that helped me get through my life at a really important time, and the way I was treated here. I was treated as family here, and it made a big difference to me. So I'm here to help and to listen. Excuse me.
Here's another question.
Oh.
Is it recommended to maximize contribution to an employer's 401k or only up to the employer's match percentage?
Always up to the match. But I want you to get up to the max that you can put in as soon as possible. Now, there's some of you may be interested in retiring young. Anybody? Okay, that interesting. I'm with you, that's great. I retired at age 40 and then started a whole new career just for fun. I didn't do it for money at all. But so that's wonderful. Choose FI is a website that is dedicated to helping people who are trying to retire early. Choose financial independence, but choosefi.com. Anybody ever been there out of curiosity? Okay. How many years have you been going to the site? A few, yeah. And it really has it been fun to, they're good people, and I think they give good advice.
Pretty much anywhere you see retirement on these slides, you could substitute financial independence or financial freedom.
That's right. That is right. It's not about retirement, it's about financial freedom. At the end of the day, if you can get there when you're 40, why not be free? Doesn't mean you have to sleep in. I do not sleep in. And I have not really retired. I fooled my wife, by the way. I told her, I promised her I would, when we sold the business in 2012, I would never work for money again. What she heard me say was, I will never work again. But I've spent just as much time in retirement doing this kind of stuff as I did when I was working, which is what I did then too, basically.
I get emails one morning. You were not retired. Let's see, some questions that came in with registry. Well, let's turn it open first.
Yeah. Who's got a question? Yes. Do you recommend what now? Oh, I think a side hustle is great. I mean, if, for example, you cannot max out your IRA or your 401k, and you want to do more because you want to get it in there early, then I think a side hustle is a great way to do it. There's a great website. It's for doctors, but it's a great website for anybody. It's called the White Coat Investor. And what Dr. Dolly, who runs the site, and he is a doctor, emergency room doctor, he tries to get doctors who are coming out of residency to live like a resident for 5 years, spend like a resident for 5 years, and put that extra money aside and to get debt paid off now. That side hustle can do a lot of things. Now, if it's misery and it's ruining your life, I don't know what to say. You do what you can with the money you got. Before I got married, there was a time I lived in a luggage room of an old house down at the University of Washington, but it was $12.50 a month. And I was always frugal. More questions? That's it. Really? Yeah.
So you had like a bunch of charts up there. So like when you, like if you have a Roth and you pass away, can your kids like retrieve money from that, or does it just like go?
Oh, I didn't make that clear. The question was, what happens to that money in the Roth if you die prematurely?
Yeah.
Or when you die, or whatever. The way there is a beneficiary. And in a Roth IRA, the beneficiary is going to, and I don't give tax advice, but traditionally the beneficiary gets to receive that money immediately if they want. Or it can be spread out over years, just like the person who died maybe was taking out 5% a year. My wife and I take out 5% a year. We take out 5% a year, which then includes the money that we have to, we pay whatever charity that we do. That's all part of the budget, but we live on 5%. And we would love it if our kids would live on 5% when we leave the money after we die. I think they'll spend it faster than we did. And in my case, a lot of my money goes to Western when I die, because I made the mistake of giving my kids half of my company when we started it. That was my mistake.
Before we take another audience question, one more from online. Should a student open a Roth IRA with income earned on a summer job?
Yes. Yes, you have to have earned income. One of my grandchildren, I used a picture on the front page of a catalog I had a catalog company at one time. And so we put the picture of Ben on the front cover, and at that time you could only do a 2,000. That was the maximum you could put into an IRA. So we paid Ben $2,000 and put the money. But if he made that money on dividends or buying and selling stocks, you can't. That kind of income cannot be used. It has to be earned income. You can, and I'm not giving you tax advice, but you can, when you have a child, you can actually have your child doing jobs that you pay them for. It's not an allowance. Jobs that you pay them for, and then they can put that money, or you can match it. Doesn't have to come from them. One of the people who follow our work sent me a picture of their 6-year-old out mowing the lawn with a plastic helmet on. But he's paying his 6-year-old to mow the lawn so that he can legitimately, and he's documented it too. So it's lots for you to learn once you get into this. Thanks. And I hope you find it, I hope the next step is a smooth one for you. I hope the company you go to work for has a really good 401k plan with good choices. Yes. Well, okay. Here, because you're here. Yes.
Maybe repeat the question.
Yeah, no, the question is, what is the name of that fund in the 401k plan? Because 403B, I'm sorry, you're right. And that is the DFA target value. It's the only.
Fund advisors, yeah.
Yeah.
It'll be the only.
Hey, thank you. Oh, yes, one more.
How do you, people are leaving, but how do you keep a cool head with all the news coming to the stock market and all the tariff stuff and all that? Like, how do you?
Remember, you do not have money in the stock market. You have money in a company that is, you are an owner of that company for the long term. They've gotten where they've gotten. Like if you were in a mutual fund that was started in the 20s, all those companies that are still there since the 20s. You know, they have gone through wars, they have gone through depression, they have gone through, you just have to rethink, repackage your thinking. You're not a speculator, it's not short term. Now, is it possible that we could collapse as a country? Well, try to cash a Confederate bond. I mean, we don't know. That's always the risk that is possible. Thanks. Good luck to you guys. Really appreciate it. Thank you, Eric. Yes. Thank you.
So that's why, quick wrap up from all of us at Western and the Merriman Financial Literacy Program. I want to thank you for joining us, and especially thanks to Paul for sharing expertise. I want to reiterate, you have free books here and free online resources, and please look for an email from us with the slides and other information. So thanks again, and
Go iGrad.
go iGrad. Yes.